This is Financial Accounting, and I'm Dr. Baldwin. In Chapter 4, we will learn how to record purchases and returns of inventory and how to record sales discounts and returns for those companies engaged in the business of merchandising operations. So the whole chapter is about merchandising operations. So far, we've been using examples that mainly consist of service companies like accounting firms, law firms, plumbing companies, etc. These companies all sell different services, but they have one thing in common. They don't sell inventory. This makes their income statements rather simple. The income statement of a service organization typically consists of revenues minus expenses to arrive at net income. Merchandising companies are different from service organizations because they sell inventory. Merchandising companies can sell inventory in the wholesale market or to final customers in the retail market. Because merchandising companies sell inventory, their income statements will have an additional expense item called cost of goods sold. The cost of goods sold account represents the cost of the merchandise sold during the period in order to earn revenue. Cost of goods sold is presented as a separate expense item on the income statement. Net sales minus cost of goods sold equals gross profit. Gross profit is the amount left after subtracting the cost of the inventory sold to cover all the other expenses and to earn a profit. The operating cycle of a business is the time it takes the business to start with cash, purchase inventory, sell the inventory, and finally collect the cash from customers. The operating cycle of a business that sells inventory on credit is typically longer than that of a business that sells only on a cash basis. This additional time is due to time between when the customer buys the inventory and the time the customer pays off the accounts receivable. This slide illustrates the flow of costs in an inventory system. If we take what we start the period with and add the net purchases during the period, so beginning inventory plus the net purchases, we have the total merchandise available for sale during the period. At the end of the period, one of two things must happen to the merchandise available for sale. Either it is still in inventory, so it's an ending inventory, or it's been sold, so it's part of cost of goods sold. If it's in inventory, the cost will appear on the balance sheet as merchandise inventory at the end of the period. If it is sold, the cost will appear on the income statement as cost of goods sold. Learning this flow of inventory costs will help you apply new material you will learn later. Let's make the entry to record this purchase of merchandise inventory. On June 20th, Jason Inc. purchased $14,000 of merchandise inventory and they paid cash. So what are we going to do? When we purchase inventory, we debit the asset account merchandise inventory for the cost of the inventory purchased. This entry is similar to the entry we would make if we purchased any asset, like a truck or land. Trade discounts are often offered based on quantities purchased. In this example, a trade discount of 30% is offered when a customer orders 1,000 units or more. Trade discounts are not recorded in the accounting records. This transaction will be recorded at the price of $3,675, which reflects the trade discount given. So 1,000 units sold at $5.25, that's a total of $5,250. We were given a trade discount of $1,575. We will record it at the cost that it's actually going to cost us, $36.75. That's what you do with trade discounts. This is an example of an invoice that would support the purchase of merchandise inventory. Notice all the different information on the invoice, such as the seller, the purchaser, the credit terms, the items purchased, and the amount of the purchase. All of the information is there that you will need when you record the entry to purchase inventory. Purchase discounts, remember we mentioned trade discounts a moment ago. Purchase discounts are provided to customers as an incentive for them to pay early. The credit period is the normal period of time the company allows for customers to extend their accounts receivable, typically 30 days or 60 days. The discount period is a much shorter period of time, typically 10 or 15 days. If payment is received during the discount period, a discount may be taken. If payment is made after the discount period expires, then the full payment is due on or before the end of the credit period. Purchase discount terms are typically written as this slide shows. This particular discount term would be read as 2/10 net 30, or some people say 2 and 10 net in 30. The first number represents the discount percentage, 2%. The second number represents the discount period, 10 days. The letter N stands for the word net, and the last number represents the entire credit period, in this case 30 days. In this case, if the customer pays within 10 days, then a 2% discount may be taken. If not, then all of the amount is due within 30 days. Now let's see how a purchase discount works. On May 7th, Jason Incorporated purchased $27,000 of merchandise on account. In this entry, we debit merchandise inventory, remember that's an asset account, and we credit accounts payable for $27,000. What kind of account is accounts payable? That's right, it's a liability account. So we've debited an asset and we've credited a liability. We're going to pay for this liability a bit later. If Jason Incorporated pays the bill on May 15th, that would qualify for the discount of 2% because it's within the 10-day discount period. In this entry, the entire accounts payable of $27,000 is paid off with a cash payment of $26,460. The difference of $540 is the purchase discount, and it is recorded as a reduction in the cost of the merchandise inventory. So it's a reduction in the cost because the merchandise inventory was recorded at cost, so we debited that asset, but now it's turned out that cost is going to be a little less, so we're crediting that asset. It's a reduction in the cost of the merchandise inventory asset. If we look at the accounts after posting the payment entry, we can see that the current balance in accounts payable is 0. We've paid off everything we owed, indicating the total liability has been satisfied. We can also see that the current balance of $26,460 in the merchandise inventory account reflects the actual cash price of the merchandise purchased. Remember the cost principle from Chapter 1, I think it was, or historical cost principle, some people call it? Well, that's what we've got here. The inventory ends up recorded at its cost. It actually cost us $26,460 ultimately. So, should we take advantage of purchase discounts when they're offered? The answer is yes. If we annualize the 2% purchase discount rate offered, we can see that it reflects an interest rate savings, an annual interest rate savings of 36.5%. That's big, big, big. So, whenever possible, we should be taking these discounts. In addition to purchase discounts, merchandisers also have to deal with returns of inventory and allowances. An allowance is a price reduction granted to the customer because of some quality issue. An allowance may be given because of a slight defect in the merchandise or because a shipment was late. In these cases, the customer keeps the merchandise and just receives a price reduction as the allowance. Let's look at an example and see how purchase returns and allowances are recorded. On May 9th, Matrix Incorporated purchased $20,000 of merchandise inventory on credit. In this entry, we debit merchandise inventory and credit accounts payable for $20,000. So we bought some inventory on account. What would be the entry on May 10th if Matrix Incorporated returned $500 of the merchandise to the supplier? This entry includes a debit to accounts payable for $500 to reduce the liability, because we've sent back $500 worth of the merchandise, and a credit to merchandise inventory for $500 to reduce the amount of the asset, because we no longer have $500 worth of that inventory. Now on May 18th, which is within the discount period, Matrix Incorporated paid the amount owed to the supplier. In this case, they can take a purchase discount of 2% on the amount due of $19,500. Remember, we originally purchased $20,000, but we've sent $500 worth back. The entry includes a debit to accounts payable for the total due of $19,500 and a credit to cash for $19,110, which is the amount due less the discount, or net of the discount, and a credit to merchandise inventory for $390, which is the amount of the discount. So we credit the inventory account, that's an asset account, to reduce it for the amount of the discount. Transportation costs are sometimes included in the cost of merchandise inventory. For example, when buyers pay transportation costs to get merchandise inventory to them, the transportation costs are included in the merchandise inventory cost. FOB terms designate when title passes and who pays the transportation cost. FOB stands for free on board. So if the shipping terms are free on board shipping point or FOB shipping point, it means the ownership transfers from the seller to the buyer when the seller provides the goods to the carrier, to the shipper at the shipping point. It also means that the buyer will pay the transportation cost because, of course, it belongs to the buyer once it reaches the carrier, the shipper. On the other hand, if the shipping terms are free on board destination or FOB destination, it means the ownership transfers from the seller to the buyer when the buyer receives the goods. It also means that the seller is paying the transportation cost because it still belongs to the seller until the buyer receives it. So, if goods are shipped FOB shipping point, then the buyer owns the goods in transit and will pay the transportation cost. This transportation cost will be added to the merchandise inventory account. Let's look at an example. On May 12th, this company purchased $8,000 of merchandise inventory and paid $100 in transportation costs. What's the total cost of the merchandise purchased? The total cost of the merchandise purchased is the purchase price of $8,000 plus the $100 in transportation cost. The journal entry includes a debit to merchandise inventory for $8,100, the total together, and a credit to cash for $8,100. So we paid for it in cash. Take a minute and read this question and see if you can determine which of the items should be part of the buyer's July 6th entry. Did you answer C? Since the terms are FOB shipping point, the buyer will pay the freight costs. Therefore, the $100 should be debited to the merchandise inventory account. So merchandise inventory on the buyer's books should be debited for the $7,500 of the cost plus the $100 for the shipping, or for $7,600. To determine the total cost of merchandise inventory purchases, we can start with the invoice price, subtract the purchase discounts and purchase returns and allowances, and add in the transportation costs. You can see this itemized cost of merchandise purchases. This detail could even be part of an income statement. Now let's change our focus and see how discounts and returns and allowances are recorded on the seller's side of the transactions. Both sales discounts and sales returns and allowances are contra revenue accounts. Do you remember talking about accumulated depreciation as a contra asset account? Well, contra means opposite or against, right? So sales discounts and sales returns and allowances are contra revenue accounts. They are contra to the revenue account known as sales. This means they have a normal debit balance and are subtracted from the sales account to arrive at net sales on the income statement. First, let's see how to record a sale of inventory. On March 18th, Diamond Store sold $25,000 of merchandise on account. The merchandise had a cost of $18,000. Whenever a sale is made, the seller must make two journal entries, one at retail and one at cost. The retail entry, that's the first one, includes a debit to accounts receivable, or cash if it's a cash sale, and a credit to sales. So we're debiting an asset, either accounts receivable or cash, depending on what happened, and we're crediting a revenue account. This entry is made for the sales price charged to the customer. The second entry is for the cost. The cost entry includes a debit to cost of goods sold and a credit to merchandise inventory. This inventory is made for the cost of the goods sold to the customer. We remove it from the asset account merchandise inventory because we're selling it, and we move it into the cost of goods sold account. Remember, cost of goods sold is just a specially named kind of expense account, so it normally has a debit balance. Let's record a sale of sales merchandise inventory for Bart & Company on June 8th. The inventory was sold on credit for $6,000 and had a cost of $3,500. The credit terms are 2 and 10, net and 30. Remember that for the seller, 2 entries are required to record a sale, one at retail and one at cost. So here's our journal entry at retail. We sold it on account, so we have a debit to accounts receivable, that's an asset, and we have a credit to sales. This is at the retail price. At the cost amount, the $3,500, we're showing a debit to cost of goods sold and a credit to merchandise inventory. We're removing it from our asset account because we're selling it, and we're moving it into cost of goods sold. We would do that at the cost. On June 17th, Bart & Company received a check and full payment of the account. This entry includes a debit to cash of $5,880, which is the amount due of $6,000 less the 2% discount of $120. A debit to sales discount of $120 is the amount of the 2% discount, and a credit to accounts receivable for the total sales price of $6,000 removes that receivable. So the customer has sent Bart & Company cash within the discount period of $58.80. So we recognize how much cash was received. We recognize that a sales discount was given, and we remove the account receivable from the books because it's been paid off by our customer. After this entry is posted, the balance in accounts receivable will be 0. Indicating the account has been paid in full. On the income statement, the sales discount account of $120 will be deducted from the sales account of $6,000 to reflect the actual amount earned of $5,880 from this particular sale. Here we have another sale of merchandise inventory for Bart & Company. This sale is on June 12th. The inventory was sold on credit for $7,500 and had a cost of $4,000. The credit terms are 2 and 10, net and 30. So what are the 2 journal entries you need to record this sale for the seller? Remember, we're the seller here. First one is to accounts receivable. In this case, could be to cash if we were paid cash, but in this case it was on account. So we debit accounts receivable, we credit sales for the sales price, and separately, we debit cost of goods sold and credit merchandise inventory for the cost of the goods we just sold. We're removing them from our books at cost. From that merchandise inventory account, we're reducing that asset, and we're showing that they have been sold by putting them in cost of goods sold. On June 14th, Barton received some inventory back from the customer. Similar to a sales entry, a return of merchandise entry requires 2 journal entries, one at retail and one at cost. The retail entry includes a debit to sales returns and allowances and a credit to accounts receivable for the sales price of $800. The cost entry includes a debit to merchandise inventory, in other words, we're putting that back in our inventory because they sent it back, and a credit to cost of goods sold for $470, which is the cost of the returned inventory. This entry is a straight reversal of the cost entry that was made when the sale occurred. So that second half, we're just flipping over what we did when we sold. The first half, we're not directly debiting sales. We're using this contra account. But we are doing the opposite with accounts receivable when they sent it back. The only thing different is we're using sales returns and allowances, this contra account here. On June 20th, Barton received a check in full payment of the account. This entry includes a debit to cash of $6,566, which is the amount due of $6,700 less the 2% discount of $134. A debit to sales discount for that $134, the amount of the 2% discount, and a credit to accounts receivable for the total amount due of $6,700. So they paid us within the discount period. They got the discount. The discount was $134, so they sent us $6,700 minus $134, and that was payment in full on their accounts receivable. After this entry is posted, the balance in this account receivable will be 0, indicating the account has been paid in full. On the income statement, the sales discount account of $134 and the sales return account of $800 will be deducted from the sales account of $7,500 to reflect the actual amount we earned of $6,566 from this particular sale. Now, in the next lecture, we'll complete the accounting cycle by preparing the closing entries, just posting up the adjusted trial balance here, and that's where we'll start next time. So that concludes Lecture 4A. Now, move on to the homework assignment. This chapter's homework is pretty lengthy, so you'll want to spread these assignments over 2 or 3 days to lighten the load. Good luck.